Hi everyone, thank you for joining us for a live webinar on Zero Commission Forex Trading on MT5. This is Phil Gunn, your presenter for today. We'll be starting the session proper at about 7:02 p.m. Let's just give about 2 more minutes for our friends to join us. Meanwhile, just enjoy your dinner and we'll start real soon. Hello everybody. Thank you for joining us for our live webinar once again on Zero Commission Forex Trading on MT5. I'm Phil Gunn, the presenter for today. I'm an account manager with Phillip Futures. In today's webinar, we'll be discussing Forex trading on the MT5 platform. Before we begin, I would like to do a sound check. If you can hear me, just type yes into the question box. Also, during the webinar, if you have any questions, feel free to type them out into the question box as well, and I will address them during the Q&A session at the end of the webinar. Okay, great. Looks like everyone can hear me clearly. So let's begin the webinar tonight. My name is Phil Gunn, the speaker for this webinar, and I've been with Phillip Futures for more than 10 years now. Since 2008, I hold a dual license in futures and stocks, and I am an account manager to help clients trading in futures and Forex, as well as shares with understanding the product and market by providing coaching and economic information to make sound, proper trading decisions. Recently, we have seen a new change in the momentum in the Forex market. That is, an emerging trend of US dollar's weakness. We will reflect on the charts in the past when historically such a situation arose, and compare with the charts today to see if we can draw any parallels in patterns. That will be left for the last part today. We'll first touch on understanding the mechanisms of Forex in the first half of the webinar. Today's topic will be on Forex. However, if you are also looking on to explore different investing opportunities, you can take a look at the US Micro Indices Futures Seminar. Simply search for the following in YouTube as shown at the bottom of the screen. Throughout the webinar, as mentioned, if you have any questions, feel free to post them. My facilitator will arrange them and let me know, and I'll answer them during the webinar or at the end at the appropriate time. This webinar itself will also be put up on YouTube after today for you to revisit if you wish to do so. Okay, let's get right into it. Before we start, a short disclaimer on the webinar today. Materials provided here is for general information and does not constitute a recommendation or solicitation to trade. The agenda. Before we start trading Forex, you need to understand the characteristics of the contract. From understanding the basics of Forex, how does the whole process work? You'll be analyzing the risk involved and developing a proper trading plan to manage this risk. So that's what we'll do first, to review the characteristics of the Forex contract. Then we will take a look at what are the common major Forex pairs that are trading. We will then move on to the calculations of the individual trades and what are the costs involved. The second part of the webinar, we'll look at the risk management aspect of Forex trading, which is critically important. As it is a leveraged product, the contract size has to be managed properly, as it is much different from the usual stocks investment strategy, where you can simply average down and hold. From my experience, many times, new traders will have a good start in Forex trading, but will escalate and increase their position sizing. This results in an overexposure of risk in a single trade and cause disruption in the profits, and ultimately affecting their initial trading strategy. Hence, risk management or stop-loss strategy has to be disciplined and solid. The level of importance of risk management is underrated and has to be treated as first priority. After that, we'll look at the risk-reward factor, where we want to trade only in better trade settings, which gives us a favorable reward in return for the risk taken. We will then simulate a run-through of the Forex movement through the use of historical charts and understand the psychology of the emotional factors that the trader experiences when trading. After that, we'll take a technical look at the charts to identify better entry and exit points. With all of the information, you can decide the type of trading plan you require to start on the trading journey. We will also look at some charts and the latest Forex trend in recent markets. Finally, we will end it off with an MT5 platform demonstration and a quick look at the AutoChartist EA. How does Forex work? Well, as everyone knows, it is a huge market. The average traded value is about US 2 billion daily. Forex is traded over the counter. What this means is all the transactions are conducted electronically and not over an exchange. The counterparty are the banks spread across various time zones of various financial institutions. There is a gap when the US banks are offline and Asia takes over, say about 4 a.m. to 6 a.m. Singapore time. Liquidity at this hour is the lowest and should be avoided. Since there's no centralized exchange, it is not transparent, and orders are filled according to the prices the banks provide. Forex is always conducted in pairs. It is the exchange rate between two currencies. For example, euro-dollar. You are speculating on the strength of euro against US dollars. A view that euro will strengthen will result in the actual value of this rate to increase. Let's take the analogy of exchanging money over at the money changer. Say, for example, the euro-dollar rate is at 1.14. This means with 1 euro-dollar, you can change it for 1.14 US dollars. If you were to go to the money changer with 10,000 US dollars and change it to euros at this rate, you will get 8,772 euros. Later on in the future, when the rate increases from 1.14 to 1.16, you decide to change it back to US dollars. Now, when you change the euros back, you will get 10,175 US dollars. Hence, you make a profit in US dollars from this exchange. So, instead of going to the money changer, using Forex contracts, you can actually avoid using physical money exchange and speculate on this exchange rate. So you can simply make an online trade to buy a contract size of 10,000 instead, at the exchange rate of 1.14. Subsequently, when the figure rises to 1.16, you can close the contract and make a profit when it rises. Hence, you are buying at a lower rate and selling at a higher rate when it rises. So it's a pure speculation of this figure, the exchange rate. Compared to money changers, using Forex, the spread is very tight at 1 pip spread. If you go to the money changer, the spread is much wider at 50 pips. Next, we'll move on to the characteristics of Forex. Firstly, this is a bidirectional market. In the earlier example, your view is that the euro will strengthen against the US dollars, so you buy the rate first. However, if you think the rate is going to drop, you can sell the rate first, then buy back later. This allows you to trade both directions of the market effectively. With daylight savings, you can trade Forex 24 hours starting from Monday 5 a.m. Singapore time to Saturday 5 a.m. Singapore time. There is no trading during the weekends as the banks are closed. Hence, you can trade on your mobile through the app or at night when you have time to monitor at home on your PC. There are various contract sizes available to adjust the risk exposure according to your requirements. In the earlier example, the 10,000 contract size is the mini contract size. Per pip movement is 1 US dollars and a big movement is 100 pips, will be about 100 US dollars. So if you think this mini size movement is too big for you, you can scale it down to the micro size. The micro size of 1,000 per contract, which is 1/10 the mini size 10,000 contract size. For 100 pips movement in a micro contract, it will only be 10 US dollars. So there's a comfortable size of contract for every trader, and new traders can start with a relatively smaller size to familiarize with the platform and trading. Subsequently, you can decide to pick a reasonable size. Can be any multiples of the micro, mini, or even the regular size 100,000. Therefore, the sizes can be, for example, 4,000, 17,000, 113,000, etc. You get the idea? All the margin, however, is in US dollars. Margin required is 5% of the contract value. So for 10,000 euro-dollar mini contract size, that will be 500 euros required, which is 592 US dollars. So for the mini contract size, with 592 US dollars in the account, you can start trading one lot of mini contract size. If you wish to do one micro, it will be 60 US dollars, which is about 1/10 of this 592. But the opening of the account requires a minimum deposit of 500 Sing dollars, which you can be used for trading. So for this 5% of the contract value, this is actually a leverage of 20 times. You don't come up with the full value of the 10,000, but only 5% of 10,000 as the margin. Due to the leverage, if the market goes against you, you need to top up the account to meet the margin call. Else, if the margin drops to a low enough level, your positions will be liquidated by the system to avoid overloss situations. We'll explain in detail on this in the following slides. Next, there is no expiry date. This means you can hold the position as long as you wish. That is, if you are willing to pay the swaps for it or the interest. Basically, when you hold the positions overnight past 5 a.m. Singapore time, you might need to pay swaps for it. You can avoid this by doing intraday trades and closing the position before you go to bed. So we have covered the characteristics of Forex. I hope you are following. Next, we'll look at some major Forex pairs that are currently trading among Forex traders. These are some of the more major Forex pairs. We have Euro dollar and Pound dollar, which are the European pairs. These are moderately volatile pairs. If you would like a pair which is less volatile, you can trade Aussie dollar or dollar yen. Dollar Swiss is a very volatile pair, and so are the other crosses that's not listed here. So for example, if you are trading European pairs, the Euro dollar or the Pound dollar, you need to follow the economic data and political events that are happening in the European zone, such as the recent worsening COVID situation in Europe and the hard Brexit. As all the pairs are versus the US dollars, monetary policies in the US will also affect the currency movement, such as the stimulus packages by Fed. We'll talk a little about it later on. So next, we'll move on to the calculations of Forex mechanics. We are looking at here the Aussie dollar pair. I can see the bid offer price is shown as 0.6954 bid versus 0.6955 offer. The base currency is Aussie, while the counter currency is the second currency on the right, which is US dollars. So one thing to take note is that the P&L will always be calculated in the second currency. In this example, that will be actually US dollars. So for one Aussie dollar contract, say the mini contract size of 10,000 Aussie, you do not need to come up with the full value of 10,000, but with just 365 US dollars, which is 5% or 20 times leverage. The smallest movement, one tick or one pip, we call in Forex terms, is 0.00030 and 11 is equals to 1 US dollars. So the following term, long Aussie, buy Aussie, or in fact you're actually selling dollar, means the same thing. Let's say we buy one Aussie dollar, assuming that we have $365 in the account exactly. We can start buying one Aussie dollar at the market rate 0.6955. After that, the Aussie dollar increases to 0.6965, and you decide to sell it at a higher price. You can see that the increment here from 6955 to 6965 is equal to 10 pips. As 1 pip is equal to 1 US dollars, 10 pips will be 10 times 1 equals to 10 US dollars. So for this trade, you have actually made a profit of 10 US dollars, and your account balance has increased from 365 to $375. This is an example of a profitable trade where you buy and sell. Let's look at another example. So for the next example, we'll be looking at Euro dollar, another pair. And as you can see here, it's 1.13771 versus 1.13778 fractional pip. The pip spread is much tighter for the Euro dollar with only 6 fractional pips. So In this example, we'll be looking at 10,000 euro contract size. The P&L is still in US dollars. So for one mini size, you require 592 US dollars or 20 times leverage. As long as you have $592 in the account, you can start one contract size. One pip, 0.0001, 3 zeros and 1 1 is equal to 1 US dollars. In this example, we have 600 US dollars in the account. Let's say we also buy 10K US dollar at the rate of 1.1377. For this example, we do not close the position, and say around settlement price, later on it rises to 1.1477. In this movement, the increase is 100 pips movement. As $1 again is equals to 1 US dollar, 100 pips means you have 100 US dollars profit. However, this is not realized as you have not actually closed out the position, and the market price is still changing dynamically. So in the account, however, you have $600 plus 100 unrealized profit equals to $700. So in the statement, we will reflect that you have $700 in the account, but it is prone to fluctuation still, depending on the price which you exit. So this is an example where you have not closed out the position, but the trade is still profitable. So let's look at an example where this is a losing trade. In this example of euro dollar again, the margin required is 592 US dollars or 20 times leverage. One pip movement is equals to $1 as usual. And similarly, we have $600 in the account. Let's say we have bought at 1.1377 of this mini contract size of one lot, and the settlement price now, instead of rising, drops down to 1.1277. In this example, there's a drop of 100 pips. So as you can see, 100 pips is equals to $100 deficit. Hence, in the account, $600 minus 100 unrealized loss, unrealized because you have not really actually closed out yet, is equals to $500 left in the account. So you can see that $500 is less than the initial margin required, which is 592 US dollars. As such, you have a margin call of 92 US dollars, which you need to top up back to the initial margin, top up to 592 in order to maintain this position. Let's say if you do not want to top up and you continue to hold, and the position continues, the market continues to go against your position and reaches a level when the funds in the account becomes 20% of the initial margin, the position will be actually liquidated. So 20% of the initial margin of 592 US dollars is equals to 120 US dollars. So when the account funds drop from 600 down to 520 US dollars, your position will be liquidated. To avoid that, you can actually top up the account by online banking, and the funds will receive within an hour to maintain the position. So far, I hope it's clear regarding this. Okay, so next we'll move on to the second part. I'll start off with the quote from Warren Buffett. The risk management part, let's start with the quote that he says, "You only have to do very few things right in your life, so as long as you don't do too many things wrong." Applying it to trading, I would like to consider, if you start trading, will it be possible to achieve a very high hit rate all the time? What if you are not able to do so? Will you still be able to be profitable? Trading is a recurring process that accumulates many trades over a period of time. Let us consider it in a string of 10 trades. Out of 10 trades, only 4 of them are profitable trades, but the other 6 are losing trades. But for each of the winning trades, the profit is $2, which gives you an $8 profit. For each of the losing trades, the loss is limited to $1, which gives you a loss of $6. Although the number of wins is less than the number of losses, the net profit is still positive, $2. In other words, by adopting this trading risk management strategy, you have placed yourself in an advantageous position, mathematically speaking, even if the hit ratio is low. To summarize, this is to let your profits run and cut your losses. The question is, of course, how do we identify the trades that give a 2-unit reward versus a 1-unit risk? So to understand that, before I show you, let's take a look at the charts and see what happens when you start trading. This is a historical daily chart of dollar yen. As you can see, the pair start off in a range before entering an uptrend market. When it was ranging, there's a sudden sell-off on a particular day. I bring you to this movement over here, which I'm referring to. So when the market comes down, some of the traders decide to sell, thinking that it's a down market. After that, the market goes against and rises dramatically. So what happens to the positions? Let me just bring an analogy. Let's say you're on the road and a car suddenly drives out of nowhere towards you. What's your initial reaction? Like most people, you probably stare at a car and not react. So this is what happened. Most traders will actually panic freeze and not do anything at first. Subsequently, the prices continue to rise, and at this point of time, they might think they are actually doing it wrongly, but would wish to have the prices come down lower before you cut. Of course, it does not do that, and continue to rise further. Finally, at this point in time, most traders who have lost quite a big amount decide to cut loss already. When it happens, we see some form of retracements as shown over here in the middle. So after that, the prices start to be in a range trading, and what will happen to the traders who have not entered at all right from the beginning? They are thinking of entering, however, they are afraid as they think that the price is too high. So they are being shocked that's so high, so they decide not to enter to buy. And we have a stream of late buyers at this point when the prices rise. So at this point of time, it goes into sideways and subsequently tapers off. So this is the stream of emotional experience that you experience when you're doing a trade. How do we avoid getting into this string of emotions? By developing a trading plan. So let's use the same chart, and I would like to use the technical support and resistance levels to help to control this. The way we're going to draw it is to draw the support line at the valley bottom. So it's very easy for first-time people who are actually looking at the charts to follow the curvature of the curve. So you can see it goes in hilltops and valley bottoms. So when it rises up, it reaches a hilltop, and when it comes down, it reaches a valley bottom. And you can draw a support line by choosing 2 different candlestick colors and drawing at the base over here like what I did. Similarly, you can also draw at the top of the candlesticks like this when it rises up, right? So over here at the tail, as we have seen the multiple revisit by these 3 candlesticks of the same position, this is the resistance level that we want to draw. And after that, it comes back down, we can draw another support level, right? So in this way, we are drawing at the hilltops as well as the valley bottoms. As you can see over here, this region of range trading is divided into the top upper region and the lower region. But overall, this is the main trading region. And as long as it's in this range, we'll be safe to say that the prices will still remain in this range. So I would like you to continue to look at the chart and decide where you can draw the support resistance levels. So take about 10 seconds and imagine where you would draw at the hilltops and the valley bottoms. Okay, so I think most of you might have seen this way at the top over here. That's correct. So at this hilltop over here, we pick two different color candlesticks, and then we draw a resistance level at the base of the candlesticks, right? So this is a major one, as we can see, another revisit of this level over here. So where are the other levels that you can draw perhaps at the bottom? There's another one over here where you can see a slight range movement over here. We can draw a little one movement. So we have actually drawn this on this chart over here. Let's see what happens after that. As you can see, the movement after the chart, we were at the beginning of this chart when it reaches the top. This is the second part of the chart where it actually comes down. And before that, we have drawn the support resistance lines way beforehand. What you see here is a drop off of the prices after the late buyers come in. And then it went through to this range over here, which I was mentioning to you earlier on. Tested the support level over here and bounces back up to the top of the range again. However, it bounced back down to the support level again and retest the upper portion. There's a false breakout here, but still well within this range movement over here. So you can see plenty of opportunities of this range movement in the upper region as well as the lower region of this whole range movement. Putting the prices into perspective makes it easier for you to see what the market is doing. So how do we make use of this information to place a trade? After drawing the support resistance line as shown, and you have clearly know how to do it, let's take a look at how we place a trade. First of all, using the same chart, when it reaches the support level, you can consider to buy at the support level. Being a support level, there will be substantial buying by other buyers when the prices reach this level. However, the way we do it is not to buy at the first touch of the support level. We will like to buy only when the prices come back up and we will enter the market. So we have a confirmation of falling day candle, probably an up candle, to show us that yes, there's some kind of support at this level. And then on the next candlestick over here, probably you can enter at 112.25. So that settles our entry price. Where would you want to take profit? Obviously, the maximum distance traveled. You can use the resistance line which you have drawn earlier, which is the top of the range, as your target profit level. So I'll typically advise to slightly take profit a little below this level, right, so that your order is going to be executed. So this movement you can see here is a big distance, and this will be a substantial profit. You can of course take profit at this line as well, but the second portion of the profit, you can take profit over here. How about the stop loss? Like most of you have guessed it, the stop loss will probably be at the lower end of this support line over here, probably 10 pips below the low over here. So let's recap. If we were to buy at the support level at 112.25, notice this is the level over here, and then we will sell and take profit at 114.76. That will give us a profit of 251 pips. The stop loss will be 111.42, just below this, 10 pips below this low over here. If that happens, that will be a loss of 83 pips. So as you can see, the profit is 251 pips and the loss is 83 pips. This will give you a risk-reward ratio of 1 to 3. So I'll give you an example of how you can go about developing a plan which incorporates the support resistance levels. To recap, the following is the trading plan that requires the following steps. First of all, the technical analysis. Right, the technical analysis is what I've shown you. The basic one you need to do is actually the support resistance level first. That serves as the basic to determine the ideal entry and exit price before you can actually implement any other indicators. But with that in mind, you have actually placed yourself mathematically in a very good position for each trade. So for your trading plan, there are three information that you have to have before you enter the trade: the entry price, the exit price, and the stop loss price. As shown before, I have shown you how to place these levels close to the support resistance lines that you have drawn. So next, you need to know the fundamental news that's going on in the political events happening all around the world. So that will be provided for by our in-house analysts as well as myself, if you have your contact under me. So you will stay off the trading if there's several economic data that's happening. For example, this week we have the non-farm payroll, which is a high-risk event. Typically, there will be a lot of volatility, and we tend to try to avoid these markets. Next, placement of trades. This I will show you by a platform demonstration later on, how you can place this and set the price levels. Well, placed on the fourth, we have the money management discipline, but this is actually the most important thing to follow. So you have to control your sizing and not to overexpose yourself. So let's say you start with a micro size and you have a string of profitable trades. Most people will actually start to increase their sizing, which I strongly discourage you from doing so. So basically, the idea is to stick to the plan and control your impulse trades. This will overcome the other emotion factors such as fear and as well as greed. Let's take a look at the historical charts of some of the currency pairs when QE was first introduced in 2008 and 2010. QE stands for quantitative easing. It is a rather unconventional monetary policy that has found widespread use in recent times. Many major central banks, such as the Federal Reserve, Bank of Japan, and the European Central Bank, have resorted to this policy to kickstart economic growth. Typically, QE works by simultaneously injecting liquidity and pulling down the interest rates. This in turn stimulates borrowing and spending activity, which in turn promotes economic growth. Over here, I present the charts for four pairs. On the top left, you see Aussie dollar, top right, spot gold, which is also available for trading on MT5. The bottom left is the dollar yen, and bottom right, dollar Sing. All the charts are in monthly charts. So each candlestick actually represents a month. The charts are aligned starting from November 2008 as the first candlestick, when the QE actually first began. The second QE is shown as the vertical line that cuts across the middle of each of the charts. As you can see, there is an obvious trend upon the implementation of QE. Both the top charts, Aussie dollar and spot gold, has risen over a span of 2.5 years. It's a long period of time, but the trend pursues for an uptrend for commodity currencies. Aussie dollar rose from 0.65 to 1.03 for 3,800 pips. Spot gold rose from 900 ounce to 1,900 for about $1,000 an ounce. Strikingly, the US dollar has also depreciated. At the bottom, dollar yen dropped from 102 to 78 for 2,400 pips. Dollar Sing went from 1.42 to 1.23 for 1,900 pips. In summary, the stimulus from the QE actually resulted the dollar to depreciate over a long period of time and commodity currencies to appreciate over the span of 2 years. This slide shows the chart from recent months with the 6 past months circled in the bubble. Since the asset purchases begin from March 23rd, we see a similar trend also emerging in the commodity currencies as well as the US dollars. The stimulus package might end earlier when the COVID crisis is over, but Fed has actually pledged to maintain low interest rates and unlimited asset purchases until the economy is out of slump. However, I would like to reiterate that the disclaimer here that This is not a recommendation for any trade. So Philip uses the MT5 on the MetaTrader 5 as the latest platform in the MetaTrader series. Coming equipped with advanced charting and technical indicators for trading Forex, it comes as no surprise this is one of the most popular trading platforms around today. Additionally, world-renowned technical analysis tools such as AutoChartist and Trading Central indicators are available in this MT5 plugin. MT5 is available on both mobile from the App Store and Play Store, as well as on the PC. So you can trade on the move or at home. For the AutoChartist instructions on how to install it, there's a URL on the top of the screen. If you have a demo account now, you can simply go and download the plugin from this link over here. There will be a video on how to do it, so I will not go through it. So now we'll actually touch on the platform on how to place the trades proper. So over here, you can see the desktop version of the MT5 platform. On the left is the price codes, on the right is the charts, and at the bottom is where you monitor your trades. So to start off, you can actually add the price codes by going to View and then Symbols to add in the pairs that you want to use. So the ones that have been added are already highlighted in yellow. Those that are not included and you wish to put it in, you can double click on it. So for example, Candy versus Japanese yen, you can double click on this pair and it will be added at the bottom over here as shown. So you can actually decide which are the pairs you wish to add into this list, and the bid and offer is shown by the side of it. To start off a trade, simply just click on any pair that you want to trade. For example, let's go to Euro-Dollar pair. By double clicking on it, it will bring up the trade manual. At the top, you'll see the currency as being Euro-Dollar. And there are two types of orders that's available for you. The first one is exchange execution. This is actually the market order. So if you would like to place and buy a trade immediately at this price, you can do so at 1708. So if you want to queue for a low price, you will select the pending order where you will queue for a price. So let's say you would like to buy at 1707 instead. You can do so by typing inside the price field 1707. Next, ensure that the direction is correct. Let's say you want to buy, it will be a buy limit order. The contract size is shown under the volume. So for micro size, it's a smaller size is 0.01. You can also put as a mini size, which we'll do so, as 0.10, and a regular size will be 1.00. So I'll place the order as 1708 now, and then I'll place this order. When I've done that, you can see that there's an order that shows at the bottom here in the order menu, below the amount of funds you have in the account. So you're queuing for Euro-Dollar at 1.1708. The price now is at 1.17085. So when the market price actually goes down to 0.1708, the price will be executed and you'll be in position. Right. So in order to make sure that we have it, you can also delete the order first, and we'll place an immediate market order. So that's what we'll do now. Go to Euro-Dollar again and place a market order to buy for mini size. Right, so I've executed one mini size order, and you can see the order being executed is shown over here, Euro-Dollar, buy one mini size lot at 1.1708. So there's a spread over here. You can see that for this mini size is currently in the loss. However, when the value over here changes to positive, right, you can actually close off the contract. So there's no commission involved in the MT5 trading platform. You can simply close out the position anytime you want when the value here is positive, and this will be directly credited into your account over here. The account funds is shown as over here, and the margin required for this contract, as you can see, is about $585. Also, you'll be able to see the percentage over level over here. So this part is important. Currently it's at 14,132%, which is very healthy. We have a lot of free margin. However, when this number becomes 20%, this position will be very much in a loss and it will be auto liquidated. So in order to avoid that, always try to maintain the margin level above 100%. So at this point of time, you can see that stop loss and target profit has not been set. We can do so by simply double clicking on this particular ticket over here. There's a ticket number I tagged to this trade over here as 1488509. So to put a stop loss, simply just key in a stop loss that you wish to take takes the stop loss when it goes very low. So for example, 1700, and a profit taking level at 1.1750, just for example, illustration purposes. So you can see that once we've done that, you can click on this button over here, and you can see that the figures that we've entered previously are shown over here. The stop loss 1.17 versus the profit taking at 1.1750. With this done, you can actually close the platform and the system will actually execute the trades when the order is done. So you have no worries that it will turn too far against you because you're protected by these two orders. So one thing to take note is you can see the swap column over here. If you hold the trades overnight, you'll be able to see interest accumulated over here. This is in absolute US dollars terms. So let's say if it shows minus 10 cents, that means you're accumulating the loss of 10 cents every day. So it's a cumulative figure. As the longer you hold, the more swap that will be accumulated. So you can wait till the profit is turns positive before you take profit, or in this case, we'll just close out the trade itself. So at any point in time, if you want to take close the trade immediately in market, you can do so. However, do not click the sell or the buy button, as this will result in extra position. So for this particular ticket ID, you can show over here. You can close this one in particular by clicking the yellow button instead. So right now we're having a loss of $2. You can do so if you do not want to hold the trade, or you just simply want to go to bid and not follow anymore. You can just close out the trade over here. So by closing your trades before 5 a.m. Singapore time, you can avoid the swaps that were accumulated. So this is the way you actually place the orders. You can use a demo account to try to practice it out. If you request to do that, feel free to type in a chat box. Next, we'll move on to the auto chartist indicator, which I mentioned earlier. Even in the demo account, you have this auto chartist over here, which can be installed by just downloading the plugin as shown in the URL earlier on. The video will be put on later on. You can refer back to it to visit the URL. So once you have installed it, you see this Expert Advisors auto chartist over here. I'll now show you how to put the auto chartist in use. First, select the auto chartist and drag it onto the chart that you want to do the auto chartist plugin. So click on OK. This will result in a few seconds for it to request for data, after which the information will pop up in this window like this, right? So just a quick explanation on what all this means. So when you tick this box, display all symbols, it will display all the possible suggestions of the chart patterns. What the auto chartist does is it actually displays the chart pattern analysis for you, so that you can see what the trend is actually doing at any point in time. So if you only wish to see the euro-dollar pair, not to see so many at once, you can actually uncheck this box over here, display all symbols, and then it will actually load only for you the current chart that is being displayed, which is the euro-dollar. So you can see over here, we have a few chart patterns. The first up is actually the flag pattern on the daily chart. So it jumps right into the daily chart. You can see here, this is actually a flag pattern, this being the flag and the stick being over here, right? So more information can be seen from this window over here, the pattern details. You can see that this is actually a direction for up, right? There's a continuation, and the pattern is still emerging and it's not completed yet. So what does this really mean? So this is actually a flag, and the pattern is on the move to test the top of this channel over here. And once it touches, the flag will be completed. And subsequently, because it's a continuation trend, it's expected to actually break as well as to continue even further. So this is actually what the technical pattern is showing as a flag that will actually think that the market is going further up. So at least for the short-term momentum, you can see there's much room for movement over here. On the right here, you can see the volatility index of each of the prices. What this means is the amount of movement that's possible for this price over here. Based on the next day, within a day, you are expected that the maximum volatility movement, it can go up to 1765. So you can see about 60 pips from here as your profit target, or you can actually go for the top of the channel if you extend this over here. Your stop loss, if you have entered earlier, could be below here or below the next day over here. So this actually enables you to set up a trade quickly by identifying the chart patterns, in this case a flag pattern. So there are other possible patterns that's available. For example, the falling wedge. Let's view, click on view, and it will pop you over to the euro dollar for our chart pattern. So for this falling wedge, you can see the pattern details. This is actually a up direction, and it has been completed. Completed because the wedge has been broken out and it has moved further up after that. So this is a little bit too late, but you can see that if you have identified as a breakout over here, you place a trade, you could actually go for a potential profit over here or over here. So the chart pattern actually does the work for you to identify the movement very quickly. And we send these reports out for all the accounts that open account with us via emails as well. So you're truly informed on a technical basis every time there's actually a potential trade for you to go into, right? So I hope this demonstration actually helped you a little bit on the MT5. We'll now move on to the rest of the webinar. So we almost come to the end. I hope you found the info useful. Let me just touch on the available services. But before that, if you are interested to get a hands-on on the demo account, you can request it via the chat box over here. Just to simply type in the request. Also, we'll be sending all attendees an email. You may reply to the email to indicate your interest in this free demo MT5 account to try it out first. So let me just explain a bit on the services. If you sign up for the account with me as your servicing AE, which is available online using this link or QR code coming up, I'll be providing the WhatsApp economic data updates every week. There will also be technical discussions on the trades, and I'll be assisting you personally with any questions pertaining to your account or any trading that you may have. So on top of that, we also have the Trading Central Research Portal. This is our in-house analyst, which provides emails, technical reports on suggested levels for your reference. There'll be other major currency pairs to assist. This will be on the major currency pairs to assist you in making decisions on entering at the better levels. So besides the technical aspect, we also have the daily commentaries, right, for fundamentals to give you updates on the economic news happening around the world. This will keep you abreast on the latest economic views that might have potential impact on the markets, saving you the work of searching for any information on the internet. Hence, we provide both the fundamental and technical aspect of trading to you, and you can also have a platform ready to enter the market. So account opening requirements is just a simple, quick online process of 20 minutes. The QR code here is being tagged to me. So if you wish to have me as your servicing AE, you can actually scan this QR code to submit the account opening online. If you prepare the soft copy of the NRIC and bank statement, for the deposit required is 500 Sing dollars. This can be funded after, so do not do this until the online submission is completed, and we'll inform you when you need to do the transfer. So this 500 Sing will actually be converted to US dollars directly because MT5 is actually a US dollars based account. So this can be used for trading, and there will be no admin cost for opening the account. Right, so to reiterate the opening link, if you scan the QR code, is the same as clicking on this link. If you wish to have this link instead of the QR code, I can email it to you. Simply just let me know by sending an email or typing in the chat box. Right, lastly, we have this promotion right now, right, on the MT5. Currently, we have what we say a lucky draw for any existing clients or new clients that place a trade, right, and you stand to qualify for these prizes over here. So basically, for one regular lot size, you have stand a chance. So you can accumulate this micro lot size to form one lot size also. So after that, we'll have a grand draw at the end of it. And as MT5 also has CFD, you can also trade, which for CFD, you have 2 chances for each of the trade you do. Right? As the topic today is only on MT5, so on Forex, so that's why we are only covering on only the Forex. So this is just the QR code to scan if you want to find out more of our promotion currently for this MT5. Right, we come to the last slide. Thanks for being such a wonderful audience. This is all the time we have today, but before that, if you have any questions, let me try to answer them. Let me see if there's any questions right now. Okay, just a few questions. What time frame do you use for Forex trading? Okay, typically, what we have to do is we have a longer time frame and a smaller time frame. The longer time frame is for the long-term perspective. So typically, I'll start off on a daily time frame first and draw the support resistance levels. After that, we'll proceed on to the 4-hour or 1-hourly time frame, and we draw that out as well, right? So it's important to have a big perspective, and we try to identify trades according to the bigger movement. But for intraday traders or even scalpers, you can actually go down to 15-minute time frames or so. But for that, I have actually a one-to-one coaching. If you wish to attend, you can actually let me know. We arrange over the internet to arrange this session because we can't meet up personally. Yep. What's a pip? A pip is actually one tick or the smallest movement. 0.0001 is a pip. So there's a fractional pip, which is 4 zeros and 1 1. But typically, we just refer it to the 4th decimal place, which is 3 zeros and 1 1, 0.0001, which is a pip. Is futures tradable on MT5? Unfortunately, MT5 is only available for CFDs and Forex, which is the topic for discussion today. For futures, you need to use the Nova trading platform to do that. So it's different because of the nature of product. It's not available on the MT5, as futures is actually an exchange traded product. Are you able to trade on my behalf? Okay, for this question, this is actually a personal account. We do not have any plans for as a what you call the account manager for you to manage your account on your behalf. So we can only provide advice and technical support for your trades. The ultimate decision to place the trades is actually still back to the individual trader itself. So for that question, we only provide the economic information, and you have to do the placement trades. So what are the popular CFDs on MT5 right now? Well, the topic today is actually Forex, but we have actually branched out many stocks CFDs you can take a look. And there's also the energy sector, which is also available. So most of the people who are actually dealing in Singapore shares or even US shares are actually trying out on the major CFDs. So any other questions on Forex instead? So over here is actually my QR code on the right to open account. And if you require a demo, you can actually scan for this on the left over here for the MT5 demo. Just put in my code ZGW and I'll follow up with you to guide you through once you're comfortable with the platform and any questions you may have. Because I understand that this webinar might be too fast for you. You need to clarify or get used to it first before you get started. It's fine. But I can also assist you in that process. So if you wish to sign up on your own, you can do so by scanning the QR code on the left. Okay, let's see if we have one more questions. All right, I think that's about the end of the webinar already. So that's the email address that I have. If you have any further questions, just feel free to drop me a message via WhatsApp or via email. So I'll get in touch with you. So this is thank you for being such a wonderful audience. This is Phil Gunn. I'm signing off. Have a good evening ahead. Thank you.